Hello everyone, welcome back to my YouTube channel. My name is Rajat and today we are going to talk about default detection. In credit risk, default detection is the most important step. In the previous video, I have already spoken about how the model, how the scorecard, how everything works in credit risk. But again, whatever you learn, the first step in the credit risk domain is how to identify a default. So that's why this process is called as default detection. Some people call it default identification. Some people call it delinquency identification. So all of them are ultimately the same. So without wasting your time, let me take you forward. Let's move forward. Let's start talking about default detection. So it's have two word. It contains two word. Default and detection. So let's talk one by one about each of these words. Okay. Now, what is the meaning of default? So when I am giving a loan, okay. So see, I am a bank. Let's say I am SBI. I gave let's say 10 lakh rupees house loan to a guy called Rajat. Now Rajat have a kind of a monthly EMI of let's say 35,000 rupees. After I have taken the loan and my EMI is let's say 35,000. Now every month I'm paying 35,000 to SBI. Okay. Suddenly one day, because of any financial reason or any other reason, there can be so many reasons. We'll come back to that. So because of any reason, Rajat have stopped paying this 35,000. So first month, obviously bank notice on the month one that Rajat is not paying the EMI. So they will say now Rajat is a delinquent customer. So in database, in bank will have a database. So in database, they will have so many tables. So there is a table called delinquency. So I have not paid my first EMI. That means delinquency is 30 days. So from last 30 days, Rajat has not done the payment. Now, again, the next month, Rajat has not done the payment. Bank will obviously give you a call, everything they will do. But if you are not responding properly, so 2 months has been passed. Now, Rajat will be called 60 days delinquent. Now, after the third month, this would be the mostly last month. That is a generic kind of a guideline by the Basel. Okay, Basel is a regulatory body. Basel is kind of a global standard of banking. They give all the rules. So as per Basel, if a customer is delinquent for more than 90 days, that customer is called as a default customer. Because the customer is not paying the money for 90 days, that means there is something extremely wrong and the person won't be able to pay the money. That could the probable chances. Now, this delinquency is further have a short form. Sometimes you will hear this very common, a kind of a term which is used in the industry, that is DPD, days past due. So DPD stands for day past due. So some customer are 30 days DPD. When I'm not paying my EMI for 30 days, I'm 30 days DPD. When I'm not paying for 60 days, that is known as 60 days DPD. Then 90 days DPD. It will be keep on going. But on 90 days DPD, they will say that this is a default customer. So this is the definition of default. Now let's go back to the second word. In default detection. Detection means we need to identify something, okay? And now it's very easy. Detection need no need kind of explanation, because detection is like we are detecting something, right? So detecting the default is known as a default detection or default identification, whatever you can call it. In credit life cycle, the whole life cycle, when you're preparing credit risk model also, this default detection is the one of the most important aspect, because without a default data, you will never be able to make or create a credit risk model. This model you can never create without this information. That's why it's a very important topic and I'm making a separate video. This is the reason. Okay. Now let's talk about how we do default detection. So there are two major steps involved in default detection. So steps total 2. Now step number 1. What we usually do, okay? So we basically try to add a logic to a monthly performance file. Now what is performance file? I'll tell you. Performance file. So we will add a logic to the monthly performance file to build a process to capture all the default triggering event and make a default flag. Okay. In the performance file, we try to make a default flag. For that, we try to do event detection. Now, what is an event? What is a performance file? Let me break it down. So, when a customer, Rajat, open the account in SBI. So, I took a loan. So, there is a loan account number. Okay. Other than that, let's say I have a savings account in SBI. I do have a credit card also of SBI. So, SBI have quite some data about myself. Let's say my savings account also and credit card also I have. Some people may have only credit card. Some people can have nothing. So that's also fine. But SBI can check this data, and this data also can be utilized as a potential performance file. But let me give a clear explanation or a definition of a performance file. So performance file always tell about the performance of the customer once the customer is part of the system. So I have taken a loan. Now I am part of the system. So SBI will have a monthly performance file. It's a monthly file, okay, which they will generate for all the people who has taken loan. It's not only generated for Rajat. So let's say Rajat has taken a house loan. So they will generate a monthly file which will have the house loan information of all the people. Then they will see that who are those people who are delinquent. 30 days, 60 days, 90 days, whatever it is. So performance file is basically a file once the person is a part of the system. So monthly bank generate it. It have all the information about the customer. Let's say some important column, salary of the customer, type of job, whether it's a government or a private sector employee or it's a businessman, then about age, experience level, because higher the experience of the person, there is less likelihood that the person will default. So many other things. So these kind of things are part of the performance file. Now, this is performance file. What is an event? Event is basically when you stopped paying the EMI. That is known as an event. That event can be because of any reason. There are so many reasons. Let's say you become bankrupt. So you were running a business. Suddenly your business has totally shut down. That is one reason. Or you lost your job. That is also one of the reasons. Or you have died suddenly. You can die, right? So that is also one of the event. Because suddenly somebody was having a 1 crore loan and that person died in a road accident. That's obviously there. All those things are known as an event. Okay. Now default flag is what? It's a column usually contained in database which will have either 0 or 1, because 0 means non-default, 1 means default. So 1 is known also as an event. That is in the terms of mathematics and probability. So this is very much important. You should know this. So this is all about step 1. Now let's move on to step 2. So in step 2, okay, to summarize the performance file from a file of a account level delinquency. So you have perf file and account level delinquency. Okay. And default event in a file of a customer level default, what you will do? So you have performance file where you have a complete information of the event. So event means like whether the customer is bankrupt or the customer is no more or the customer has lost the job. So that is also one of the reason. Now using this event, you create a whole episode. That is again a banking terminology. Now I'll explain it to you. What is the meaning of that? So I'll give you pretty much simple explanation here. Okay. So when you have an event, so there will be a date. Let's say this is July. Okay. So today is, let's say, July 7th, 6th. Today is 6th July. So 6th July 2025. The event 1 happens. This is your day 1 when you stopped paying the EMI. So your episode start as an individual customer. So there will be so many episodes that will start. Sorry about my spelling, guys. Let me correct it. So this is your episode start date. So this is your episode start date. Now bank will check you for almost 12 month to 18 month from this particular day. There should not be any other default payment. Okay. So this 12 to 18 months period is known as a cure period, or also known as cooling off period. Cure period or cooling off period. Till that time, it's 1 year will be completed when? In July 2026. This is known as a whole episode. So that cycle from the day 1 when the default or delinquency happened till the whole 12 month or 18 months, every bank have a different kind of judgment about that. That whole cycle is known as a episode and also is known as a cure period or cooling off period. Now the question will come, what is the difference between a cooling off period and episode then? So I'll tell you. Let's say this was the first month I stopped paying my EMI. Then I again paid in August, in September, in October, let's say 2025, I again did not pay my EMI. So in that period, my cooling off period will be from October 2025 to October 2026. This is the new cooling off period. So cooling off period starts from the day you have done the last default. Although the episode length will be this much. So episode will start from July 2025 till October 2026. So I hope this is pretty much clear. What is the difference in a cooling off period and a episode also? It's very much clear. Okay. So the terminology which you should remember is episode, then events, then default flag, then cooling off period. So these things you just remember. These are very important market used credit risk related terms. Okay. Now event, I spoke about that. There the person is not able to pay because of so and so reason. So there are so many type of event. Let's say the person is having a restructuring of loan. So bank will also try to solve the problem. If a customer is having kind of a jobless, right? The customer lost the job. So bank will offer them that you can restructure loan. Okay. Maybe try lesser EMI, which you can afford. So that is also known as a type of a event. Okay. Then charge off, that the customer is now cannot pay the money. They have lost something. They have lost their whole business. The customer will not be able to pay. That is known as a charge off. Charge off means when bank decide that this money is not going to come back 99%. Only 1% chance is there, but bank put that money into charge off bucket. Now, last event example is bankruptcy, where the customer declare that I am bankrupt. For example, you can take name of Vijay Mallya. Individually, he has the wealth, but as a company, Kingfisher declared the bankruptcy. Now Kingfisher don't have any money to run the business, and as a company, that is known as a bankruptcy. Then in such cases, usually the state government or the federal government get involved. Okay. Now on that note, I would like to conclude this video. If you like the video, like the content, please hit the like button. Please subscribe to my YouTube channel. That really motivates me. And please share this video with your friends, your family, colleagues, everybody, so that I can get motivated more and more. If you have any question, please put in the comment section. I will reply to it 110%. So for today, I will take a leave from all of you. All the best, guys. Get a very good job and then thank me later. Thank you.